Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris McIntire. McIntire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Chris McIntire, Northwestern Ohio's resource for a common sense approach to planning. President and founder of McIntire Retirement Services, Chris strives to give Northwestern Ohio savers and investors the guidance and perspective to make well thought through and informed decisions with your money. And Chris, today, talking everybody's favorite topic. It is tax season after all.
Yeah, it certainly is. And, there are two things in life that are certain out there, buddy. And, one of them is taxation, and we won't talk about the other one.
Yeah. Sometimes it feels like we are taxed to death, Chris. I mean, honestly, it feels like it's a double whammy. Both happen simultaneously. And then some of us are going to be taxed at death.
Yeah. I was always wanted to do something for our clients, and I may yet to say, like, look, if you earned $1,000 and we're in the 22% federal income tax bracket, 4% state income tax bracket here in Ohio, here's how much you would get to keep. And then if you went to the gas station and bought $60 of gasoline, here's how much of that was in tax. And then if you bought $100 of groceries, well, I guess sometimes the groceries aren't taxed. But you stopped and bought some clothing and paid sales tax, just literally out of that $1,000, how much of that truly was yours that the government did not take?
It would be surprising to many, I think, and probably get a few people a little hot under the collar. So we know that taxes are a pain, and I've heard that they are a good problem to have, but I still hear the word problem in there, Chris. So we want to try to address that issue today, because I don't think anybody wants to pay more in taxes than their moral, legal, and ethical minimum obligation. There's kind of two ways to pay taxes, one set for the informed and one for the uninformed, and both ways are legal, Chris.
Yeah, no question about it. And, as we talk about tax season right now is, we're talking about something that happened in the past, basically, I think for most of today's show here is, what happened in 2021 that you may have to make up for in 2022, so to speak. And, there are income taxes, there are capital gains taxes. Some of you are going to get 1099. Some of you are going to get K1s for real estate and 1098s as well. So there are a number of different forms and methods that of levels of taxation that the government, different agencies from the federal to the state to the local level, commercial activity tax, just a whole plethora of things that are out there. And, being self-employed, we have to make estimated taxes off of what we earned last year, kind of sets the case going forward for this year. And they assume we're going to make more money, so our quarterly tax payments go up. And it forces us to budget very diligently. My wife says, I said, man, what happened to the checkbook? She's like, well, I made that fourth quarter estimated income tax. Even though I think we way overpaid, we still have to make that so you don't get in trouble, and, as you know, when you're self-employed, man, and pay 4 of those a year, those are substantial.
Yeah, absolutely. Well, Chris, we've heard it, and we've even already said the term tax season, and that really has to do with preparing. But should we think of taxes just in one season, or really is it an ongoing process that we need to rethink and think about a little bit more proactively and on an ongoing basis?
Well, definitely something you want to do proactively, Peter. And, when we talk about Roth conversions, a lot of the CPAs that we have our clients go to, we ask them, look, run some projections so that we have those projections in the file. And that way we're not bugging you, constantly on, hey, here's how much income they had. And for most of us, we do our Roth conversions later in the year after people have already had all of their income. So it's kind of a fourth quarter item for us. And, unless something drastic happens, like the stock market falls by 30%, for example, then we may say, hey, let's do a Roth conversion now. And, hopefully we'll ride the recovery wave here. But when it comes to capital gains taxes, that has to do with buying and selling of stocks and bonds that are outside of your retirement account. So we call those non-IRA or non-qualified. They're not qualified for special tax treatment, you would say, like an IRA. You can buy and sell inside your IRA all day long. And as long as you don't get a check, you're not spinning off any taxable event. But if you have a non-IRA account and you were buying and selling Bitcoin last year and, IBM stock and Amazon and whatnot, there's where you're going to be spinning off some capital gains taxes. So you'll get those 1099s, and sometimes you're going to get them from a mutual fund company because you're not into buying and selling, but you have assets outside of your IRA account. And this would be very important. And we remind our clients of this, is if you have substantial funds outside of an IRA account with mutual funds and you have done some buying and selling, it is not uncommon that you get a corrected 1099. So we always caution our folks to say, look, I know you want to get your taxes done February the 2nd, but wait until probably April the 2nd. That way, if the mutual fund company restates some of their dividends, they found a miscalculation or something like that, they send you a corrected 1099. You don't have to go back and amend a tax return with additional costs. So again, non-IRA assets, if you have a lot of those, you've done some buying and selling, you might have some master limited partnerships, all kinds of different pieces, real estate income, some of that stuff you don't get until much later in the year even. K1s typically, that's a whole different animal, as you know.
Well, we need to understand all of those forms and what creates them. And we also need to understand the opportunities to better control what our ultimate tax liability will be as we look at preparing the tax returns for the income we earned last year. And on a proactive basis, we can actually do more with the time that lies ahead and the taxes that we will pay than we can on the income that we've already earned last year. And that's why there needs to be a much greater focus. The shift in focus needs to be more toward proactive tax planning. And that's something that Chris McIntire does each and every day for his clients there at McIntire Retirement Services. If you'd like a financial, an investment, a retirement planning review with that proactive approach to preparing for your financial future and the tax liabilities that you will encounter along the way, pick up the phone and give Chris a call at 800-868-1194. That's 800-868-1194, 800-868-1194. Request the time, the opportunity for the conversation and the complimentary review and retirement planning strategy session. 800-868-1194. That's 800-868-1194. Chris, there are kind of two different areas where we are taxed. One on income. And for the most part, the government sort of sees a lot of that money and takes the tax bite out of the income before we even see our money ourselves, at least for the income tax standpoint. And then we pay the taxes, pay the bills, we spend some money, and we save and invest. Once we save and invest, there's a whole nother area of tax code and tax law and tax implications on our investments versus on our income. And a lot of times we're more focused on the income side, but can do more with the investment side.
Yeah, that's a good point there. And talked a little bit about that on the investment side. If you're investing inside your IRA and you've done very well, hey, maybe you got $1 million in your IRA account, but remember the tax implications that has created. Every dime you pull out of that is taxed. The more dimes you pull out of it, the more of those pennies that you're going to end up paying in income taxes as well, because as your income goes up, the percentage of tax that they take out of that goes up as well, Peter.
It doesn't seem like pennies very often. Chris, we have been saving in this country for decades under the paradigm that we will be paying lower taxes in retirement. But I've kind of scoured the earth and I have not seen it anywhere written in stone nor in the tax code that automatically retirees pay lower taxes. Is this something that has been true, is true, and will continue to be true? Or is this just a fallacy that we really need to rethink?
Well, our tax code, if you go back and wanted to Google the U.S. income tax history, and you look back at like 1986, for example, and said, okay, what's the income on $68,000 in 1986? It was like 38%. Okay. So now our tax code is, you'd have to have about $600,000 to be in the 39% tax bracket, I believe, 39.6. And so there is no guarantee that just because you're retired, you're going to pay less in taxes. For many folks, that's certainly the case, because if you got a husband making or a wife together making $150,000 while they're working, if they retire, their income is going to be dictated by how much they get from Social Security, from pensions, and from social and out of their investment pieces. So they can certainly control that income element much more. And that's where the tax planning comes into play. Peter, I'm a tax geek. I can talk about this stuff all day long. And, how do we manage that tax situation? So for example, in 2021, if your income's just about $80,000 married filing jointly, you go from the 12% income tax bracket on every dollar that you're paying. And then as soon as you get into that, let's say you work your way up to $90,000, you're now paying 22% taxes. So you go from 12 to 22%. And, you get a standard deduction where you don't have to pay any income taxes on some of your money. So in theory, or in reality, I guess you could say, in 2021, because that's the season we're paying taxes on right now, if your income married filing jointly is $100,000 or less, minus 25,100, okay, for the standard deduction, right? That's 12% income tax. That's not bad. The next bracket's 22. So why wouldn't you want to max out 12% versus going into the 22% for IRA distributions that may come down the road? And if you're watching on the podcast here, I talk with my hands quite a bit. You can see what I mean by that.
Well, Chris, it sounds like over the last 35 years or so, tax rates have come down, or tax brackets have widened to a great extent. And so most of us probably are paying effectively a lower tax rate. We fall into a lower tax bracket. And it does sound like you identified a couple different areas and opportunities where retirees could potentially pay less in tax. So it sounds like, to this point, tax deferral on a lot of our investments, specifically for retirement, probably was a good idea. Do you think that that continues, and that we should always across the board continue to defer and delay paying taxes as long as possible? Or are there times now, and is there an opportunity where we should rethink continuing the tax deferral?
Yeah, that's a great question, Peter. And I'll answer that in a couple of different fashions. So, for those of you that are retired and your income is lower and you don't need a lot of income, that's where you can start, controlling your income better in utilizing Roth IRA conversion. So you're paying tax on some bits and pieces over the course of time. In a lot of cases, at age 72, those required minimum distributions start coming out of your IRA, and it's about 4% of the total, to use a round number. So if you got $1 million, just to make math easy for radio, in an IRA account, that's a $40,000 required minimum distribution. If you're 67 years old and you don't need that money, why not take the required minimum distribution now and put it into a Roth? You can get 5 years of distributions. You can get, essentially in using this math, $200,000 out of your IRA account and put it into something that's going to grow tax deferred. It's going to be tax free later down the road for you or your beneficiaries. And then you should ideally have less money in your IRA for the forced distributions. And remember, with the Secure Act that was passed in December of 2019, Peter, when you pass away, your IRAs have to be distributed within a 10-year time frame if they're going to a non-spousal beneficiary, so a kid, a child, or a grandchild, for example. And then so they've got to withdraw all of that money within a 10-year time frame. And let's assume they're working, making a couple $100,000 a year. Now you're adding more income onto creating a bigger tax problem for them. So a couple of different ways to look at it. So here in the clear and present for the IRA owner, or down the road for the IRA beneficiary?
Chris, when we are looking at this system, though, and we've earned income all our life with Uncle Sam sort of already being paid for most of us, W-2 income, Uncle Sam takes his bite out first. And then in retirement, we start taking distributions from those retirement accounts, and we get to pull out the money and then spend it, and then the bill comes due. Does it make taxes in retirement more of a noticeable pain? Do you see than during our working career for many folks?
I think most people become more cognizant of what they're paying in taxes because, if they want to do a withdrawal, we've got to put the percentage that they want to have taken out for federal and state income taxes, assuming they're here in Ohio.
Yeah, I guess my question, are retirees more aware, does it seem to you, of the taxes that they end up paying?
Yeah, I would think so, especially if they're our clients, because we're a little more involved in it in by and large, especially with folks with larger IRAs on and making sure that we're taking advantage of the Roth side of things there, because it's tragic when you lose a client, but it's also a nice benefit when you're talking to a beneficiary and say, well, look, this, we pulled a couple $100,000 out of their IRA at minimum taxes, put it over here in a Roth IRA. This is yours, income tax free. And, so, you have to do your due diligence, and we're fiduciaries. We like to act in the client's best interest. And we would certainly think that being proactive on the tax side of things is certainly in the client's best interest. Now, not everybody's quite as active as we are. So I'll put a little commercial on our radio show or give ourselves a pat on the back for that.
Well, again, we are talking with Chris McIntire, and if you would like an advisor with a proactive approach to handling your planning, your money, your finances, your tax liability now and into the future, pick up the phone and give Chris a call for that complimentary review and that retirement planning strategy session, 800-868-1194. That's 800-868-1194. Chris, you mentioned passing assets on to the next generation, and a lot of people don't fall in a category where they will encounter inheritance tax, or it's also been called the death tax. However, a lot of people probably also don't realize that there are, once again, different levels to taxation. And if we pass on retirement accounts and tax deferred assets before we even get to a question of inheritance tax, that money still has to be taxed as income. Income tax will come first. And it essentially serves potentially as a de facto death tax.
Yeah, that's a good perspective on it. If somebody was going to pass away and you got a child that says, you got to put your mindset in that of a beneficiary. So for them, a grandparent or a parent passed away, made them a beneficiary of $100,000 IRA account. Okay, money they didn't earn as a beneficiary. Okay. So maybe they want to buy something, pay something off, and they're going to say, you know what, I'm just going to cash out of this, or my wife wants us to do this. And I'm sorry, I always blame the wives here, guys, because and I should share that equally, my bad. But if the beneficiary is married, there's two people in there making the decision, and somebody may say, look, we need a new car, we need to do this, let's just cash it out, we'll get all this stuff done. And then all of a sudden they realize, God, we just added $100,000 to our income tax bill. And on April 15th, they find out that they owe another $20,000, because of their other income that got added. So, it's not just the IRA owners that they're the retirees that are usually pretty cognizant of this. It's the beneficiaries, and some of them are very wise, obviously, and some of them are, what do they call that? Penny wise and pound foolish or something. Is that the cliche?
And yes, but however wise they are, Chris, because of new law changes and the control that the government and the IRS have over those retirement accounts, even if they wanted to continue to defer that tax implication, that tax liability, there are now limitations that they can only do so for a period of time. And just as recently as 2 or 3 years ago, we could have generational tax deferral, but the laws change. The IRS is the managing partner, the rule maker on these accounts. They changed the rules, and now we see that those accounts are actually required to be distributed much quicker.
Yes, and losing that stretch IRA provision was a wonderful benefit. Maybe it'll come back at some point in the future. It's hard to tell, but a lot of times, they grandfather from this date, and so who knows where we're at with this. And even the estate tax, like you said, Peter, the state of Ohio used to have one. We do not now. But states like Florida and Tennessee don't even have income taxes. So, many people or retirees choose to move into states like that when they retire to further cut their tax bill, and worry about their estate. Why do you think so many athletes live in Florida, guys? It's not just about the weather. They want to keep more of their millions, if you will.
Well, Chris,
good old Tiger.
I want to talk about a couple different implications of deferred taxes into and throughout retirement. We've talked about on previous programs kind of the gross planning mistake, where somebody looks at their lump sum, looks at the income they need to withdraw, and says, that's it. I'm going to pull this $50,000 out, and doesn't really think twice about it. We called that the gross planning mistake. If you plan on gross numbers, you forget about the tax implications, then you may be in for an unpleasant surprise. However, that's not the end of the story. Tax deferred income and withdrawals in retirement can actually cause a double and triple whammy when it comes to your Social Security and your Medicare premiums.
Yeah, exactly, Peter. And a lot of times these are wake-up calls people get at age 72 when those required minimum distributions come into play. And, maybe they were keeping most of their Social Security payments without having to pay income tax on it. It's what Peter's referring to. And the issue there is that, a married couple with less than $44,000 of income gets to keep a significant portion of their Social Security benefit without paying tax on it. They go above that $44,000 threshold, which is nothing in today's world. Some of these Social Security factors are the income thresholds for the taxation of your Social Security benefit, are the same level they were in 1983 and 1993. Those items have not been adjusted for inflation. Then you get into the Medicare premiums that comes out of your Social Security benefits, what Peter's talking about. What was it? $148.50 for 2021. I don't have the 2022 number memorized yet.
For the Part B premiums. Yeah.
Yep. For the Part B premiums, that gets deducted from your Social Security benefit. If you pull out $50,000 out of your IRA and put a down payment on a condo in Fort Myers, for example, then you get a bill next year saying, hey, your Medicare premiums going up because of your income was so high. Like, well, our income wasn't high. I just took some money out to put on a condo payment. Well, it showed up on your income tax as income.
Chris, this is just another reason why income planning is so important. And we talk about income planning from the perspective of the confidence of being able to generate the income based on that plan. But through that income planning process, you really uncover a lot of opportunities, perhaps, to better structure the assets to generate the income in a tax advantageous way.
Yes. And, that's where those Roth IRAs are so handy. The cash value inside life insurance is very tax efficient as well. In having some of these things in place, and some of you have plenty of time ahead of you to do these things before required minimum distribution start, because you cannot take a required minimum distribution and convert it into a Roth IRA if you're 72 or over, And so, understanding what kind of income you're going to have. And Peter, you've done a very good job of, helping us with some illustration pieces, some spreadsheets, if you will, that have a required minimum distribution formula in there. And we can say, okay, well, here's your balance at age 60. If you make 6% on it, here's your balance that you're going to have at age 72. Here's your required minimum distribution. And you make it a visual piece. It's like, a lot of people listen to this radio show as they're doing things. And when they come into the office and we show them things, that's a much more, you go from audio to visual. Most people are very visually oriented. And man, it's a huge wake up call. They're like, yep, why have we been going down this way? It's like, because everybody else was, right?
Yeah, it's what we've been taught to do. And I like that visual aspect of it, being able to see in 5 years, in 10 years, here's how much the IRS is likely to require you to withdraw. And then based upon that, here's where you'll likely fall in the income tax brackets. There's a lot of number crunching that can go on in those retirement reviews and those strategy sessions. And as you are structuring, designing the written retirement income plan, a lot of opportunities can be identified, ladies and gentlemen. That's what Chris McIntire and the team from McIntire Retirement Services strive to do for their clients. If you would like to take the time for a complimentary review and strategy session, pick up the phone and give a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Chris, you kind of talked about this window between 60 and 72. That really is kind of our window of opportunity. That's the red zone where we can control our own destiny, where we can really make our own rules to some extent. And we have some flexibility to really maneuver and move things around to control our tax liability.
Yeah, we certainly do. And, don't go into the mindset of, well, income taxes will be lower when I'm retired. I mean, they are very low right now. I mean, go back to 1980 when Ronald Reagan was elected. What was the top income tax rate? 70%.
Wow.
It's now 39.6 on a gazillion dollars, basically. It's an entirely different world. So if you're using a 30-year-old mindset, you need to get into a more up-to-date type of mentality with all of this. What are we dealing with in the clear and present, and what does the future look like after 20-30 trillion dollars in money that's been printed?
Yeah. So Chris, great point. It's not something that you need to wait until you're 60 to start doing that income planning and identifying some proactive, efficient tax strategies. If you're working and saving along the way, even better. Like so many things with money, the earlier you start, probably the better off you're going to end up. But if you've already built up a large tax deferred balance and you're within that window, you've got some great opportunities there to control your own destiny.
Yes, you certainly do. And no one's going to control it for you. You have to take charge. And this is one area where if you need some help, I think we can help provide some good, sound financial advice, wealth planning, and tax strategies for you as well.
Well, the IRS, they can set a few of those rules. Those required minimum distributions are a thorn in a lot of people's sides, Chris. They basically are a minimum payment inside of your tax deferred account, your 401k, your IRA. You always have to be cognizant of and aware of the bill that you owe to the IRS and those required minimum distributions, just like a required minimum payment on a credit card, a required payment on a mortgage. Chris, there's no better way to emphasize that there is in fact a debt there inherent in the balance that you look at when you're looking at those accounts and at that statement, when they start requiring you to make withdrawals so that they can collect their minimum amount. But again, there are a lot of strategic opportunities, and Chris, you help to identify those so that your clients can be more efficient and effective with their income and their taxes moving into and throughout retirement.
Yep, we certainly do. We do a lot of qualified charitable distributions out of IRA accounts, and take advantage while we have them now. Who knows if we'll have them 5 and 10 years down the road.
Well, if you'd like to identify some of those strategic opportunities for ongoing contributions, maybe doubling up the opportunity that you have to get money into a qualified account, possibly for a married couple, taking advantage of both spouses' ability to contribute. Plus, right now, we've got a window where you can contribute for last year and this year. So if you've got some extra cash sitting around earning next to nothing in a bank account, this could be a great way to get that money growing tax-free for your financial future. Chris can help you identify where you've got those opportunities available to you. Pick up the phone, give a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Chris, taxes are a pain. They are a good problem to have. It means that we earned some money, we made some money, but nobody loves paying taxes. We want to control it where we can. And we appreciate your guidance on this program. I'm sure we'll be talking about more about taxes in some of the weeks to come and months to come leading up till tax filing deadlines.
My pleasure, everybody. Stay safe out there. Thank you for listening this weekend.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.